us for today's seminar. I'm so glad you all showed up today. I really appreciate it. A couple of housekeeping items on your table in front of you. You'll find a place to write notes. You'll find my seminar survey. And I'll just tell you now, that's really important for me to fill out, or for you to fill out, because it gives me critical feedback to make these better. Plus, there's a $50 gift card drawing for everybody that turns them in if they're filled out. So I'll remind you that at the end. There's my brochure, and then our guest here, Eric, brought these, which are for you to take home. It's gonna repeat what he's gonna talk about. So if you have additional questions, you can refer to that or always give Eric a call. If you can silence your phones, that would be great. And if you need the restrooms, they're out the door to the right. Okay, once again, I'm Terry Diamond. I'm a realtor with Berkshire Hathaway. Many of you that have been here before know who I am. We have several new people today. New people, raise your hands. Yep, awesome, thanks for coming. I'm a realtor with Berkshire Hathaway, and why would a realtor do these presentations? Because I'm a certified senior housing professional, and working with seniors is my passion. Being a certified senior housing professional, in town you'll find many people with the SRES, or the Senior Real Estate Specialist designation. The CSHP requires about 6 months of continuing education, a lot of reading, a lot of research, a lot of visiting communities, learning to work with seniors. I am one of 6 realtors in California that has this designation. So that's what makes me different. So this is not a sales presentation. That's all you're gonna hear me talk about, who I am. It's not about real estate. It's about education and advocacy and working with seniors and helping you learn about different aspects of what's available for you to help. In the brochure, you'll see a list of all the seminars that I've done for last year, just to give you an idea of things we talk about. I will be publishing them for next year, but not a whole year's worth. In January, I think we're going to do one on downsizing. February will be on Alzheimer's, and March will be Dying with Grace with Arlene Steputat, who is a death doula. So I found that really interesting. I sent out a survey to everybody that attended asking what they were interested in, and that came out to number 1. So I expect that to be a really great seminar. After the presentation, we'll open it up for questions until noon or whatever comes first. Eric Miller is my guest today, and I'd like to welcome him. Thank you, Eric, for coming. Why don't you tell us a little bit about you?
Sure. So my name is Eric Miller. I work for Mutual of Omaha. I am a reverse mortgage advisor. Today we're not going to talk. Well, we are going to talk about reverse mortgages, but it's a different variation of a reverse mortgage product that probably most of you have never heard of. I've been in finance for over 35 years. I was a financial advisor. I've been in banking. Lending is probably the part of banking that I enjoyed the most. So I started to focus on reverse mortgages only about 15 years ago. And so today with Mutual of Omaha, that's all I do. It's just reverse mortgages. Today we're going to talk about the lifestyle home loan, again, which is a variation of a reverse mortgage, but again, probably something you guys are not familiar with. And I'm going to run through a PowerPoint presentation here. It's pretty new. It's put together by my company. I think it's got a lot of information that we don't necessarily need to talk about today. So we're going to pick our way through this presentation and pick out the important stuff and talk about the stuff that I think is important to you and make sure that you have an idea of how this loan works and how it might fit into future needs of your own. Let's see. Can everybody hear me okay?
Yes.
Thanks.
Sorry for the technical difficulties here.
you? I'm so much better. I just got a new knee a few months ago.
Isn't that wonderful?
Well, finally, yes.
Isn't that wonderful? Good.
Yeah,
I'm glad. You look fantastic.
yeah. Thank you. So do you. You always do.
You're tired, I think.
Are you still at home?
It's so warm here. Love it.
Nice to see you.
Good to see you.
Sorry, folks. We had that all set up before we started. So I'm sure a lot of you are familiar with the way a reverse mortgage works, or at least heard that term before. It's a way for people who already own a home to take equity or to extract equity out of that home, convert their equity into cash, to be used for anything you want to use it for. A lifestyle home loan is a purchase money loan. So this is a loan that would be used to purchase a new home. It's frequently used for those that are looking to right size, downsize, upsize, get into a new home that they might not have thought of that they've been able to do before without using some sort of financing. So a reverse mortgage for purchase, or as Mutual of Omaha calls it, a lifestyle home loan, allows you to buy a home, finance a portion of that purchase price, but as the same as a reverse mortgage, there's no required payback of that loan for as long as you're living in it. So let's say let me give an example here of somebody I was just working with. They were living in Hope Ranch. They had approximately a $3 million home that they sold for, they had a lot of financing on it, so they had $1 million mortgage on the property already. There was a lot of deferred maintenance on the home. They had a lot of credit card debt. So their cash flow was in real trouble. They needed to do something. They didn't know what they could do because once they sold the home, paid off all their debt, they were only going to be left with about $1 million, which here in Santa Barbara was not going to be enough to get them into a home that they were going to be comfortable in. So what they did was, using this lifestyle home loan, they sold their home in Hope Ranch, paid off all their debt, took care of all the deferred maintenance that was on the home. They ended up netting about $1 million out of the transaction. They took this $1 million, I supplied them using a lifestyle home loan, and gave them an additional $500,000 in financing, and they were able to buy a $1.5 million home and have no monthly mortgage payment. So they have a $500,000 worth of financing using this product, but there's no payment associated with it. There's no principal or interest payment, and as long as they live in their home, they're not required to pay back any of that debt. Does that make sense? No. It's sort of a new concept.
What happens when they pass away? What happens?
Just like any other loan, it needs to be paid off. So because we're not charging any interest, or because we're not charging the client who has the loan, they're not paying a principal interest payment, that interest is we're gonna keep track of the interest that's being charged. We charge interest on a loan just like any other loan. We're gonna add it onto the principal. So if you borrowed $500,000, that loan is gonna slowly grow over time as that interest accrues. But to you, as a homeowner, that doesn't matter because you're not making that payment. It's no concern to you really how much of that interest is accruing. When you eventually leave that home, that's when the home would get sold and that loan would get paid back to the lender. Sure,
In your
yeah.
example, did the people put the $1 million down, or did they keep it as cash to play?
Sorry, yeah.
Sorry. In your example, did your client put the $1 million down as well, or did they keep the cash to play with?
In this case, they did put down $1 million because it was a $1.5 million purchase.
So really, they just had a $500,000 loan that they were paying on
Exactly.
for however many years till they died, and then hopefully, okay, that makes
Exactly.
sense.
Yep. I had another scenario with a woman who was living in Santa Maria. She really wanted to get into Santa Barbara. This is where her kids live, this is where her grandkids live. But the thought of selling in Santa Maria and moving to Santa Barbara, the numbers just don't work. She didn't have any extra cash that she could put into the transaction. She ended up netting about $600,000 out of the sale of her home in Santa Maria. She took that $600,000. We located a house in here in Santa Barbara for her to purchase. We came in, I think at the time it was probably about another $500,000 to $600,000 using this type of loan. She was able to buy a home for $1.2 million here in Santa Barbara. And again, just like her home up in Santa Maria that she owned free and clear, she used Prop 13, transferred her tax basis. Besides a small increase in homeowner's insurance, she didn't have any extra cost because she had no mortgage payment associated with that $600,000 in financing. So she was able to move from a $600,000 home to a $1.2 million home with no change to her cash flow.
Are there any kinds of properties that are excluded? For example, if I wanted to buy a manufactured home, would that, could I qualify?
Sure, you can use a manufactured home. It has to be on land that you own though. So I know there's not many places here in Santa Barbara where you actually own the land. I think, I can't think of the name of it, off of Ward Drive. There's a park there where Rancho Goleta,
Yeah.
exactly.
Somebody who finances mobile homes told me that at least to get financing through him, it wasn't sufficient to own the land, that the property also had to have gone through some hoops at the state level so that they're certified, and the only one in this region is in Oxnard. And I can't remember what the name of that.
No, you can definitely get financing on manufactured homes. To do this type of financing, though, it has to be real property, meaning you have to own the land. But many of the parks here, I mean, my mother lived in Rancho Santa Barbara.
Yeah.
You don't own the land there, but she was able to obtain financing. Yeah, there's several banks in town that do that.
Yeah.
Montecito Bank and Trust.
Community
and
West.
Community
No,
West.
not to get financing,
Oh,
I'm
sorry.
sorry, but to refinance my current home, to take money out to buy a property before I sold my home. So it's the same idea as what you're talking about, but anyway, he said no, not unless anyway.
Is it a single family home that you own?
No, I'm in a condo right now.
Okay, so maybe, looking at maybe type of a reverse mortgage transaction to do that, to get the equity out, is that what you were?
I looked into that separately with
Okay,
with
you do,
someone
right,
else.
you have to have if it's a condominium, it's gotta be FHA approved,
That's correct.
right? And that's a process you can go through, not all condominiums are gonna be approved.
I know ours wasn't.
Yours wasn't, okay, sorry, yeah, then you're really sort of stuck there.
You're gonna just have to look at your
Oh,
computer.
shoot,
Yes,
how does that go wrong?
Yeah, the interest rate that's being accumulated, is that a fixed rate that you have, or is that a variable?
There's two different options, there's a fixed rate option and there's a variable rate option.
Is it competitive with any kind of a mortgage, or?
You're gonna find that, the rates on these are gonna run 2 to 3% above traditional financing.
Is that right?
You're gonna pay a little bit of a premium for that luxury of not having to pay it back in your lifetime, yeah. So you do pay a little bit of a
So
premium.
in other words, it could be about 9% now, or something like that?
You're right about right, exactly, yep, yep, today.
okay. Richard?
See if we can run through some of the slides here.
Richard has a question.
Oh, sorry, Richard, yeah.
Hi, yeah, I'm not quite clear on who actually pays off the loan. Is it your estate, or is it paid off from the sale, or your presumed sale of the house after you die?
Okay,
Did everybody hear the question? Okay.
yeah, so you make this transaction, you end up in your new home, you live a great life, time comes that you're no longer living in that home. That's when that loan becomes due and payable. So just like any other loan, whoever your heirs or your estate is designated as, they take control of the property. They are then responsible for paying off the debts that are on the property. Normally that comes from the sale of the home. So whatever proceeds come out of the sale are used to pay off that loan. Whatever remaining equity is left goes to the heirs or to the estate. Just as if you had a traditional 30-year fixed rate loan, really no different.
So can the repayment of the loan be deferred until this house is sold?
Until the last borrower or homeowner is no longer living in that home. That's when it's deferred to and gets paid back.
Whether or not the house is sold, it's due upon the demise of the homeowner.
Correct.
Okay.
So if let's say your children, the home's been in the family for generations and they really want to hold on to that home, they just need to figure out a way to get their own financing to pay off the reverse mortgage debt or to pay off this lifestyle home loan debt.
Okay.
and then that way they could keep the home. But somehow that we've gotta come up with a way to pay back what's been borrowed and that accrued interest over that period of time.
Okay.
So am I correct in thinking that if the home's underwater, the homeowner or their heirs are not responsible for the debt? Did you cover
Good
that?
question. So this is a non-recourse loan, which means that the only repayment that can be recovered by the lender is what comes out of the sale of that property. So if in the unlikely situation, let's say you owe 1.5 million and the home is only worth 1.2 million, that $300,000 difference is forgiven. FHA, Federal Housing Authority, there's a mortgage insurance premium that's paid up front that helps cover that, but that debt is paid by the lender. So no money will ever come out of any heir's pocket or borrower's pocket if you end up in an unlikely situation of being upside down, owing more than what the home is worth.
Okay, let me interrupt for a minute. I'm sorry we couldn't get the PowerPoint up and running, and I didn't hear his introduction. Is everybody clear so far what you've heard? Are there more questions before we get back to the program? Okay, he's gonna work just off his computer
Sorry,
and
folks.
talk off the slides there, so I apologize for any technical difficulties. We had it up and running.
I don't know what happened. So I think what might be helpful is if I believe it's page 10 of the booklet that you're holding on to.
That's okay.
This one? I think it's page 10. Nope. Yes, it is, page 10.
Do you want to booklet?
There's a chart on the left-hand side there. The one I was gonna put on the screen has much more relevant numbers to Santa Barbara. These numbers here don't really fit, as you look at the purchase price here starting at $350, ranging up to $900,000. Not really appropriate here for Santa Barbara, so, but the percentages really work the same. So if you look at the highlighted example, there's a purchase price of $600,000. The $383,800, that represents the amount of down payment that would be required if you were age 70. So it's a larger down payment than if you were to go out and get a traditional 30-year fixed rate mortgage. You might only be required to put down 20%. It is a larger percentage, but the idea here is that hopefully you're selling one home and looking to get into the right size home, whether it be however it's more appropriate, whether it's the right size, downsizing, eliminating stairs, getting closer to family and friends, getting closer to services, just reduce square footage, whatever the reason you may be that you're looking to get into a new home. Hopefully you're gonna be pulling equity out of that home, which would allow for a much larger down payment. So in this example, let's see, 383.
Well, I'll give you an example from here. If the purchase price is $1 million and you're age 70, okay, 70, your payment would be $670,000. If you're age 75, then it's $641,000. Or if your age, we'll skip all the way to the end, if you're age 83, it's $528,000. And that's the only thing that you have to pay besides property taxes and insurance and upkeep of the house. So you take that extra $500,000 and you travel, or whatever it is. That's the beauty of this, is that, and you can never lose your home for non-payment because it's guaranteed for as long as you live. So rather than having a traditional mortgage at $1 million, if you have $1 million, say $800,000 mortgage, your mortgage payment is gonna be, in these days with the interest rates, can you do math in your head?
No.
A lot. The highest that they changed it was $1,200,000, and you can get a home here, a nice condo or a smaller home like a 2-bedroom, 1-story home for $1,200,000, especially with prices dropping as they are right now. At age 70, for $1,200,000 loan, your payment would be $819,000. At age 83, it's $655,000 change. So it's roughly a little bit more than half of the home's value that you would end up putting down. But it's really nice. I mean, how many of you don't have a mortgage right now? Okay, wouldn't you like to live out the rest of your life without a mortgage? So you're going to sell your current house, well, if you went with this program, you take half the proceeds from your house now, which has risen 20, 30, 40, 50, 200% in value from when you bought it. Take half the proceeds, buy your new home, and never have to worry about a mortgage again. That's what I think is so great. I mean, not having a mortgage, not having to worry about that monthly payment is security in a way that you can't get it. Other than paying cash for your house, if you wanna pay $1 million or $1.2 million for your house in cash, that's great, but why give the bank $600,000 when you could keep that? So,
Where I frequently have seen it is, those that plan on paying cash for a new home, and rather than paying, let's say it's a $1.5 million purchase, rather than coming in with a full 1.5, you come in with $1 million. Take that other $500,000, put that to work. You still don't have your monthly mortgage payment because we're using the $500,000 using this lifestyle home loan, no principal interest payment, but now you've put aside $500,000 for living expenses, travel, whatever, the millions of reasons you could use that cash for, cash flow.
So in 10 years, what does that $500,000 cost you?
That depends on whatever the current interest rates are, and I could show you, if you gave me particular circumstances, I can run a scenario and an amortization schedule that shows you exactly what that loan balance is gonna look like 5, 10, 15, 20 years from now.
Okay.
I've also seen it in a situation where people are looking to get a bigger house. So maybe I've got 1.2, 1.3 to work with. I'm moving from Goleta, but I wanna be downtown, but the purchase prices are 1.5, 1.6, it's just not gonna work, I'm gonna have to go get a mortgage, get this type of mortgage. We give you that difference of $300,000 to $400,000 to get you into the 1.6 property, coming out of a $1.2 million property, and still remain mortgage-free with no principal interest payment.
Let's say I come into a lot of money and I wanna pay off that loan, can I do that?
Absolutely, yeah, there's no prepayment penalties of any kind, there's no required holding period of any kind. Title stays in your name, whether it's in your trust, your individual names, there's nothing tricky about these. The home is completely, it's yours, it's just a lien on the property. The big difference, there's no monthly payment associated with it. So yeah, title stays in your name and there's nothing unusual, other than the loan has to be paid off when you no longer live there.
And that, excuse me, and that, I pass away, she still can live there?
Yes, as long as one borrower remains in the home. Good question.
Okay.
so you both have
Okay,
to
here-
be on
oh,
site.
no. That other person died, okay, just,
Yeah, as long as one of the borrowers is still living in the home,
okay.
it continues on.
I gotcha.
Is
Yeah.
related to this, so say the person left behind in this situation, say had to go into an assisted living situation, they're not deceased, but they can't live in the home anymore.
Mhm.
Is the loan due in that scenario where the
If it's
person
gonna be
is
after
still
1 year,
living?
yes, if it's gonna be, if it's usually within 1 year, you know whether or not you plan on trying to get back or not. But once you reach that 1 year, that's when it becomes technically due and payable.
Okay,
Yeah.
Eric, let me repeat that question, because that's really
Sure.
good. Did everybody hear it?
No.
So, what the question was, is if you have a lifestyle home loan, you're living in the home, you have to go to an assisted living community. What happens to the loan? You have up to 1 year to move back home, otherwise the home gets sold or back to the heirs?
Loan is due.
The loan comes due, that's a better way of saying it.
Yes.
Okay, so that's a really good point, because after a year, you'll know whether you're gonna be able to go home or not. So, very good question, thanks, Michelle. Pam, did you have a question?
Yes, what's the youngest age that this is available to?
The minimum age, you said?
Yeah.
Yeah, so for this particular FHA product, it's 62. What we haven't talked about, and I was going to get to later in the presentation, is that there also are, they're called jumbo loans, jumbo reverse mortgages for purchase. So it's really the same thing that we've been talking about here today, but it's a loan that's offered by the individual lenders. There's 3 or 4 of these programs in the country today. Mutual of Omaha has one. They'll look at the true value of the property. So there's no caps on property values like there is on this FHA one at 1.2. They'll look at the true value up to $10 million. The minimum age for that product is 55. The way these loans work is that the amount that you're gonna qualify for, it's age-based. So the younger you are, the smaller amount that you're gonna be able to borrow. The older you are, the more you're gonna be able to borrow.
there
That's
a
very
maximum
specific
age?
just to your age. I'm sorry?
Is there a maximum age?
No maximum age.
So no maximum age
I've
for
done one of
those.
these for a 103-year-old.
Wow.
That's a bold move.
And then the loan to value is very high. You're gonna be able to borrow a much bigger loan than you would if you were just 62. The idea is that they need to leave room for the interest to accrue to make sure that we don't become upside down.
Sue? Margie.
Does the interest rate stay the same, or does it,
Depends on if you have a variable rate or a fixed rate product. So if you have a fixed rate product,
okay,
interest rate doesn't change. It's very predictable exactly where that loan balance is going to go. If you choose a variable rate product, then yes, then it's a little bit harder to project where that interest rate is gonna go or where the total loan balance is gonna be because the interest rate's gonna fluctuate. But
So-
you're gonna get a lower rate if you choose the variable.
So how often, do the variable rates adjust?
Yeah.
Monthly,
Monthly?
but they do have caps. So
Okay,
no
what's
more
the
than
cap?
2% 1 year and then 5% lifetime.
So if you had a fixed rate, could you refinance?
Yes,
Okay, and there's a cost to that, I assume?
yes, but they're
Normal.
reduced significantly. They don't charge you the same fees that they would charge you in the first place. So refinancing is an option and it's a lot less expensive.
So at 9%, which is what, if you went for a fixed rate today, it would cost, traditional rates right now are about 7. Maybe get a fixed rate and wait till they drop down to 3 or 4, which I believe that they will again, and then refinance in a couple of years.
They're already starting to drop, which
Yeah,
has been
we're
wonderful.
down to, what did we see the other day, 7.03? So, good discussion.
Let's see what else we can talk about here.
One further, do the same factors apply in deciding whether you want fixed or adjustable?
So the question is, do the same factors apply? Maybe the same criteria for qualifying, apply if it's fixed or variable?
Right now, we're sort of in a funny situations because interest rates are so high. Right now, the fixed rate is offering less funds than the adjustable rate. So a lot of people are just choosing the adjustable rate because it's giving them a higher loan to value or a higher loan amount. They're getting closer and hopefully that they'll hit that point where they'll be equal again. So then it's just a matter of preference.
Mary?
how does this apply, compare, maybe this isn't a fair question, I don't know, but how does this compare to bridge loans?
Huh.
Is that is that a doable comparison, or is it apples and oranges, or?
The question was, how does this compare to bridge loans? You wanna take it?
Yeah, I'm thinking about how I would answer that.
Okay, bridge loans are an entirely different animal. So bridge loans, you borrow from the equity of your current home to buy a new home, but then the old home gets paid off and you still have a mortgage on the new home. So you still have a mortgage, unless you pay. My client just got a bridge loan on her old home, and then paid off her new home when she sold her old home, but she paid cash. Okay, so she could have saved $500,000 and added it to her savings if she went with the lifestyle home loan rather than paying cash for the new loan. Bridge loan doesn't really compare to this. A bridge loan is keeping your home while you buy a new home, using that money from a lender, which is super expensive and high in fees. She paid almost $50,000 in fees to borrow money for 2 months. So, but that's what she wanted to do. She didn't have, well, she had a $95,000 mortgage on her old home, and she bought a $900,000 home, but she didn't want a mortgage. Had I known about this program at that time, I would have suggested do this. But she also, with today's market, with the inventory not so high, she didn't want to be left without a home. So that was the driving decision behind her choice of doing the bridge loan. She wanted a place to move into before she sold her own home. So,
And with your loan, you can't do that.
This would be permanent financing, as opposed to a bridge, which is a short-term gap between two properties. This would be a permanent purchase money loan on a new home. So it's just a different animal.
And how much percentage on the value of the home that you have, what's the percentage that you, max out on, say you got a $3 million home? And, how much could you borrow on something like that?
On a $3 million home?
Yeah.
At what age, approximately?
70.
70, I'm gonna just take a wild guess and say 40%.
40%,
Okay.
40% financing, 60% down payment.
I got you, okay.
So the question was, on a $3 million home, which we're getting into jumbo loans now,
Okay.
what's your down payment? And it'd be about 60%, a 60-40 split at age 70. So what about at age 80? Putting you on the spot here.
We're making you older. Then I'm probably gonna say it's around 50-50.
So, yeah, well, we have all sorts of ages that come to the seminars. So we have everybody from, 50 to 90. So I think it's important information. Okay, what are we gonna talk about next?
So this product has only been around since 2009. Reverse mortgages have been around since the 1980s. But this purchase transaction's only been around since 2009. And that was really, the purpose of it was to eliminate the need to do two transactions. So people would, I guess they would sell their home, take the cash, go buy a new home, then turn around and do a reverse mortgage to pull out a chunk of that equity. Now they've created it as a purchase transaction, so there's no need for the two transactions anymore. They make this a purchase money loan as opposed to making it a cash out transaction on a home that you currently own. So a lot of people are not familiar with this.
I have a question.
Yes.
I have a remark and then I have a question. For those of you who've been coming to my seminars, you hear me at the end in the remarks saying, reverse mortgages are not what they used to be. Okay? So, hence my friend Eric here, because they're not what they used to be. The second part was, to qualify for the lifestyle home loan, do they have to sell their current home first? How does that work? Can they buy a new home without selling their old home?
Absolutely.
Okay, do you want to talk about that or have you already?
No, so yeah, if you have the assets to cover the down payment on the new home, then it would sort of eliminate the need to have to time the market, worrying about moving, in one weekend, concurrent transactions. You're selling one home, needing the proceeds from that one to get into the new one. If you've already got the assets for the down payment on the new home, then that would allow you to hold on to your primary residence, put the down payment down. We provide financing on the other portion. You buy your new home, which then allows you to do any deferred maintenance, stage the home, and sell that home on your own time, as opposed to being rushed into the transaction. Does that make sense?
It does, but what if you don't have the assets?
Then that wouldn't be an option.
Okay, so
Yeah.
you still have to sell your primary home. How fast can we get the new loan done to purchase a new home?
30 days, just like traditional financing.
And you have to be able to sell that home within a year, or pay the loan back.
Now, that's on a bridge loan.
No, because you gotta be a resident in your home that you.
Right, well then you buy the new home, you'd move, but then you can take your time selling your previous residence.
Yeah,
You wouldn't
up to
be-
a year.
No?
No, okay. Okay.
No?
So could you rent it out?
The prior residence?
Yeah.
Absolutely.
Yeah.
Okay.
Yeah. A lot of people wanna replace the assets that they just depleted for the down payment on the new home, so they're looking to get that other home sold, but it just puts you on an easier time frame than if you were trying to do it all together at one time.
But didn't you say that an owner has to live in the property?
Yes.
The new home, what they use the lifestyle home financing for, they have to live in that property. Your old home, Larry, I think you were speaking to a bridge loan where you have to pay it off in a year. But apparently if you have the assets to buy the new home on the lifestyle home loan, you can do whatever you want with your old home. You could rent it out, you can get it ready for sale, you can do whatever. Yes.
I would make an application for a loan.
You see this man here, we'll talk about that after. Mary?
Say you're looking to buy a home and you have found one, you need to sell your home first to do that.
Maybe.
How would the offer to the person selling the house that you want,
It would be a contingent offer.
it's a contingent offer?
So if,
Well, that, we know from experience, contingent offers based on selling your house first are a no-go in this area.
it depends on the market. From here until the last 2 years, nobody was able to buy a home on a contingent offer. Does everybody understand what a contingent offer is? Okay, So you have to sell your home before you can close on the new home. If you don't have the assets to buy, and correct me if I'm wrong, if you don't have the assets to buy under the Lifestyle Home Loan Program, you have to sell your home first, but to buy a new home, you have to make an offer. It would be contingent on selling your current home. Did that make sense?
But with this loan, it's contingent on getting approved for the loan?
Well, you still need the asset.
Well, you need the down payment assets, but not the rest of it.
Okay, let's have a conversation about that after,
Okay.
okay? Are you ready to move on?
Yes.
And then qualification, oh, another question, yep.
How would that work in an heir situation where one might want to buy out another or the other heirs? Does it apply?
Oh, I'm sorry, I didn't catch that.
If you have an heir situation,
And heirs.
HEIR,
Yeah.
not heirs, that where one might want to buy out the other because they already own a portion of, would it apply?
Can you give me an example? I'm not quite following that.
Okay, so my sister and I inherit the home and I want to buy her out. So I
This is the
have-
home you already own?
I have a half interest in it because I've inherited.
Gotcha. And you live in it, or?
Well, you would, yeah. Would it apply? It's tricky. Terry knows.
Pam, I know the situation, let me talk to Eric about that, and we're gonna defer that.
Sorry.
Because
Wait.
it's such a specialized question, we'll defer
Okay.
that to after. But that's a good question. Okay, you ready to move on? Okay,
We could talk about qualification. So a lot of times what's preventing some people from moving one house to the other is that I'm gonna have to obtain financing. I'm not gonna have enough cash in order to, I can't pay cash for this house entirely, or if I do, it's gonna leave me broke and it's not gonna be a comfortable situation. But I'm not sure I'm gonna qualify for a mortgage, I'm on a fixed income, credit issues, whatever the reason may be, that obtaining traditional financing is not an option. With this lifestyle home loan, there's no required credit score because there is no payment. As long as you're paying your property taxes and homeowner's insurance, that's the only requirement on these loans that keeps you current, then we're not really, there's no need to qualify, I guess is what I'm saying. The level of income can be really anything, as long as you're able to pay the property taxes and the homeowner's insurance. So there's no debt to income ratios. Qualification is a lot easier than it would be trying to get a 30-year fixed rate mortgage.
so, but there are steps to qualification to make sure that you can pay your property taxes. Can you go a little more in
Correct.
depth about that?
Yeah, so that's the requirement of this loan, is that it's gotta be your primary residence, and you have to stay current on your property taxes and your homeowner's insurance. And truly, if you're already doing that today and you own a home, then that qualification, more than likely, you have the income level to pay your property taxes and homeowner's insurance going forward, and that's what they look at. Have you been paying those items on time?
So do you have to provide bank statements or tax records?
Usually, we look at what the property taxes and homeowner's insurance is gonna be, and then we look at the income,
Okay,
which is usually, we keep it simple, W-2s, 1099s for social security.
okay.
And
Have
usually-
you ever had somebody that didn't qualify?
It's been a very, very long time.
Okay,
Yeah.
okay.
It's not very common that you don't qualify.
Are these loans also available on condos?
On condos, they have to be FHA approved.
Okay, everybody
So-
hear that, because that's important, I'm sorry for interrupting. So they're available on condos if they're FHA approved.
The homeowners association, so they have to look at the financials of the HOA to make sure that they're financially sound. Some homeowners associations already are. It's an easy lookup. There's a website through FHA online that you can look to see if it's currently approved. If it's not approved, it's a process that Mutual of Omaha will get done, but it can take 30 to 45 days. So for a purchase transaction, if you're looking to buy a condominium, it can be very difficult because it takes that 30 to 45 days to get done. And it's just difficult if you're trying to make a purchase. For those that are trying to extract cash from a condominium and they plan on remaining there, then that's, we can wait 30, 45 days to get that HOA approved through FHA, and then do a cash out transaction. But for a lifestyle home loan, if you're looking to buy a condominium and it's not already approved, it's difficult,
Right.
unlikely.
And you can just call me and I can tell you whether it's approved or not. Most of them here in the city are. So,
Even those on the land lease?
like Alisal?
No,
Or-
like Tracy Drive and.
Oh, that's a good question.
What was it?
If you have a land lease,
Condo.
is it, land lease condo, are they FHA approved?
I believe, aren't those, isn't that a PUD or townhomes?
They're PUDs.
It may be an HOA involved, but if it's a townhome or a PUD, then there's no approval necessary.
Oh, good to
A lot of
know.
people think they live in a condo and they truly live in a townhouse or again, a planned urban development.
Richard?
Yes, advantages to this lifestyle loan aside, am I right in assuming that the down payment for a 30-year mortgage would be significantly less than the down
Yes.
payment required?
Yeah, more than likely 20% is the minimum, yeah. Obviously, that makes for a bigger loan, so you have to qualify for that 80% financing, so that's a difficult part when it comes to doing traditional financing as opposed to this, is that you've got to qualify for that loan. So you have to show the income to be able to afford that 80%
Right.
financing.
Sure. And I find that most of my clients who are buying new homes on a traditional mortgage, they have the assets to put down 50% because they don't want a, $2 million mortgage. So once again, why not put it into this type of loan and not have a mortgage payment? So, okay, move on. Your turn.
Let's see what I can find here that we haven't talked about.
So you could pay off if you took a loan like this, you could pay off your interest every month. So
Yes.
at least you keep your equity on it.
Yes, and I've had people do that. I've had people that are 62 that have taken these out. They're still working. They
Yeah.
continue to make payments on this loan even though they're not required, just to keep the interest in check, or
Okay.
knowing that at any point I decide to retire, I can now retire my mortgage. I don't have to make any payment
Yeah.
if I don't want to.
Okay.
Yeah.
Good question.
So the loan to value I was talking about was based on age. The younger you are, the smaller the loan size is going to be, or the smaller loan to value. And they use that based on the youngest borrower. So if we have a 62-year-old and a 70-year-old, we're going to qualify you on the 60-year-old for the lower loan amount.
That brings up a question I thought of. You brought it up. If you have two people living in the home and one of them passes away, can the other one stay? The answer is yes, but they both have to be on the loan.
Both have to be borrowers,
They
correct?
both have to be borrowers. So you can't just have the loan in your name.
You could also have a situation where one borrower is 62 in the qualifying age, but their spouse is 58. You can still do the loan. The loan is based on the 58-year-old, even though they're not of the minimum age to be a borrower. So they're called, it's a non-borrowing spouse, meaning we're qualifying the loan based on the age of the 58-year-old, but they're not a borrower. But they do have the protection that if something happens to the 62-year-old, the 50-year-old, 58-year-old, or whoever old they are at the time, can remain in the home for the rest of their life as well, as long as they're still married. And that's it, that's referred to as a non-borrowing spouse.
So you can't do it with a child.
You could, but the loan to value would be so small. Oh no, sorry, they're not married.
So
I
you
take
have
that
to be
back.
married.
Yes, you have to be married, that's
Okay.
the,
What if you're of age and you're living together and you both are owning the home?
I'm sorry?
What if you're not married and you're buying the house together?
That,
And you're in your 80s.
Trick question.
that's a good question, but it's just recently changed too. Let me see if there's, I haven't run into that.
That's a really good question, though. What if you're not married, but you're both of age and want to buy the home together?
You could do that, but I believe you both have to be 62. But yes, you could do that, you don't have to be married.
You could be more than 62.
Or more, oh, of course, yes,
Okay.
yeah, I'm going with a minimum, but yeah, anything about that, of course, yep.
Okay.
And the older you are, the more you'll be able to borrow.
Thank you.
Can we clarify that? At one point you said you have to be married, but what if siblings wanted to buy a house together?
That's fine, yes, if they're, as long as they're both 62, yep,
Okay, so this, you have to be married, is not really a qualifier.
no.
Okay, scratch that idea.
Thank you.
So I have a sale coming up. The gentleman's 82 and he has an adult daughter he's gonna go in to buy a house with. And the adult daughter, I don't know her exact age, but it's probably 55.
Oh, sorry.
Sorry, no, that's fine. So, gentleman's 82, he's buying a house with his daughter. Daughter, I don't know her exact age, but I would imagine she's probably 55. Not my age, no, just kidding. How does that work, or can it work?
That would work using a jumbo, because that minimum age is 55.
Okay,
Yep.
got it.
And the idea of the protection there is that if something were to happen to him, that loan does not become due and payable. So that's why she would want to be on the loan,
Got it.
if at all possible.
So if it's a grandchild that you're looking at doing that with, the grandchild would also have to be 55 or older?
If you were looking to purchase the home with the grandchild, yes, yes.
Well,
Yeah.
I'm not gonna live that long.
Yeah.
Yeah, when it gets to be, is 55 the minimum age? Or if you're going to buy?
To be a borrower.
Okay, 55 minimum age to be a borrower, I didn't catch that earlier. So if you have a grandchild, they're probably not 55 yet. So, but if you and your daughters wanted to buy a home, if they're 55 and over, they could do that. Okay, I'm not gonna talk to them so you can figure out what to talk about next. Pressure.
Geez, we've run through the whole thing, pretty
Okay.
much, yeah.
Do you want
It's
to?
very condensed.
I know we don't have a thing, but why don't you put on that video and turn it up so people, this is real life scenarios, and I thought it was a good video. It's testimonial, but it talks about the advantages of the home loan.
Is this from Tom Selleck?
No, not from Tom Selleck.
One of them, his name is Tom, but it's not Tom Selleck.
We're gonna get you guys out of here early today, but that's okay. Any other questions? Nope. Okay, so I want you to listen to this. While he's doing that, make sure you ready? Okay, here we go.
Let's see what this sounds like. That's not gonna be loud enough.
To have a payment, to have your house and have more house than you dreamed of having.
Nobody here. Oh, wait.
The heck of allow us to not only get into a new home in an area where we wanted to be, in a house that we wanted to be in, but it allowed us to free up money from the sale of the original house to buy a small condo for our daughter and grandson to be in. Tell me about a heck of a loan. And he said, my 62nd birthday, I'm gonna go get him. I'm from the school, if it sounds too good to be true, it usually is. Was a bit miraculous that we were able to pull all of that off and still have money to decorate the house the way we wanted and not have a mortgage as we headed into retirement. Why do we want to put all of our money into a place to live and then have no money to enjoy whatever good mobile ambulatory years we have left?
First of all, we couldn't have afforded a place that nice without bunching our savings.
The advice that I give to someone who's on the fence about the heck of it is, nothing has gone differently than what we were told would happen.
It gave us the freedom to still be able to travel, have a nice home, not have to worry about as much financially. So it's like that.
Can I get a copy of this?
Of course.
Okay, so I'll get a copy of this and send it out to you guys. Also, I'll take a copy of the updated rate sheet and send that out to you. So, yeah. In your book has copies of more information that we talked about today. Diane, question?
I'm gonna ask the hard question. We have heard so many negative things about reverse mortgages. Can you summarize why this is different? How does,
Flip it back first, and do you know what negative things you've heard, or from who?
I know,
Okay.
It's just, everyone says, don't do it, don't do
Right,
it.
I run into that a lot.
Yeah.
I probably spend half of my time educating financial professionals in town, financial advisors, insurance people, CPAs, lawyers, because there's a complete misunderstanding of this product. It's been around since the eighties, to be honest, back in the eighties, it was a pretty crummy product. There were a lot of pitfalls.
Because, I mean, the negative is coming from a lot from people who mostly have parents who have done something like this.
Gotcha, okay, so, again, yeah, it used to be a pretty crummy product, there were a lot of pitfalls going back into the eighties. FHA, in the last 10 years, Federal Housing Authority and HUD, has done a lot to try to clean this program up and make it as consumer friendly as possible, because they do realize that, a lot of people have not saved appropriately for retirement. And then a lot of people's wealth, usually their largest asset is tied up in their equity of their home. So they need to try to figure out a way for people to safely access equity. And the way that product was run was not the answer. So again, they've made a lot of rule changes. They've cleaned up all the sort of the I gotchas. They made it a much nicer product and taken away those pitfalls. Unfortunately, those myths and perceptions still persist today.
They're still selling reverse mortgages, right?
Oh, 100%, I'm very busy,
What
yes, here locally.
makes them less wonderful than what you have?
Right now, it's a very
The same thing?
vanilla product, yes. We're all operating under the same rules. Federal Housing Authority dictates how these programs are run, so everybody has the exact same product.
So then the follow-up is, if they're both the same, why would I want to choose yours?
Mainly, one, I would say my experience. I've been doing this for a very long time, and I specialize only in reverse mortgages. There's lots of lenders out there that they do everything, and they really don't have an understanding. This product's unique, it's different, there's a lot of ins and outs to it that many lenders are not familiar with. So specializing in, I think, it is key. And then, of course, my company. I mean, I could challenge you to go find any reverse mortgage company that anybody else in here has heard of. You won't find one. Mutual of Omaha is really the big name in the industry. They're the most trusted. I mean, they've been around for 120 years, everybody knows them. So we're the number one lender in the country too. A lot of people may have heard of Tom Selleck,
Yes.
or seen those commercials,
Yes.
but I would challenge you to, what company does he represent?
Yeah, good question.
Yeah.
I think one point I wanna make is Eric is, whenever I have a reverse mortgage or a lifestyle home loan, Eric is my go-to guy. But the important thing to remember about today is about the lifestyle home loan where it's a purchase.
Yeah.
Where a HECM or a traditional reverse mortgage is to get money out of the house that you already own. So that's a big difference. That's what I wanted to bring to you today, that this is for purchasing a new home,
Excellent, thank you.
okay?
But your question is still valid. It's still under the umbrella of the same
Yeah,
product, so
yeah,
those concerns
But
I
I
can
mean, I
completely
asked what's the
understand.
difference, and the key difference is
This is for purchasing, yeah.
as opposed to suck money out of all.
And many of the professionals that I go and educate today, they're still under the perception of the way this product used to be in the eighties.
Yeah.
So I think a lot of people are still stuck in that, and I think a lot of children may not be in huge favor of it because now some of that equity is disappearing from their home because that interest is accruing.
Right.
And so children are gonna get less. They're gonna see less of an inheritance on the backside. You will have lived comfortably and gotten what you needed out of the home,
Right.
but there might not be what they were expecting to be there, so they may not have a positive outlook on it.
But another plus, I know from the, senior retirement communities, that you have to put down a big down payment just to begin to pay the rent. So in many ways, this is a kind of if you don't need assisted living, or you don't really wanna live in a community, I think this sounds like a really good idea.
Absolutely. That's a
Being
great
in your own
idea.
home and getting the home that you are
And
gonna be
buying a
comfortable
home
in.
that suits you as opposed to going to a community.
Right.
Right, but yeah, living in that home with 2 stories or
Yeah,
whatever it may be,
exactly.
this is just an alternative to try to find you that right property,
Yeah.
your dream home.
Yeah.
And this can be a way of getting there.
What is the average upfront cost to get this thing going?
I'm sorry?
What's the average upfront cost to get, one of these
It
reverse?
varies on the loan size, but if you're looking at the maximum loan sizes, so if you look here in Santa Barbara, if you're getting a home that's gonna be $1.2 million or above, it can be somewhat more expensive than traditional financing. So there's one big large fee that's upfront. It's paid directly to FHA. It's 2% of the purchase price, up to 1.2. So you're looking at a 20,000 plus mortgage insurance premium, plus the traditional closing costs, title escrow and appraisal. So it's a little bit more expensive than a traditional loan. Again, you're paying a little bit of a premium to not have a payment.
can you roll that into the loan or not?
Yeah, so when we talk about these loan to values, that's the fees coming off the top. So that's what you're left with after the fees have been paid for. Yeah, you don't have to come up with any money out of your pocket, it comes out of the loan proceeds.
So a couple of points that I want to reiterate that to me are really important. No credit score needed. You don't have to be married. Never a payment. You can't lose money after you pass away. Your heirs will not have to come up with money if the home loses value. That just gets forgiven by the FHA. So they will never have to put money out of their product, and you'll never have a mortgage payment again in your life. So, yes, you put more down than the traditional 20% mortgage, but trying to qualify for that other 80% when you don't have income is a challenge in today's banking environment. So, if you have to sell your home to use this product, that's something as real estate agents we can do in today's market. As we're getting more to a neutral market, contingent sales are going through. When it's a seller's market, there's no way. When it's a buyer's market, which I don't know if we'll ever get back to, but it's definitely something that can be done. What other, if you had to pick the top 3 points, what would they be?
I think you just covered them.
Okay.
First and foremost, if you think this was something that might work, but you're hesitant or it's hard to generalize this product out to everybody, I would love to hear your specific situation and have Terry and I review that and come up with hard numbers for you. So this will really pencil out, make sense, you can see it on paper, exactly what this would look like. And first and foremost, I'm an advisor. I'm not a sales guy. I'm not here to try to sell you guys anything or pitch you or bother you if this isn't something that's gonna work for you. I'm here to assist Terry and hopefully find something that's gonna work for you guys and get you into the right house.
So, excuse me, so to do this, the people that are involved in this whole thing is yourself, a broker, and the owner.
I provide the financing.
I provide the real estate,
Okay.
Berkshire Hathaway,
Right.
or you're using
Yeah.
Nico's with
Okay.
whoever. Richard?
Yeah, this would obviously work better if you have a house presently to sell, but have you ever worked with someone who's renting, but who had the assets to provide the down payment for this kind of loan?
100%, oh, sure. Yeah, absolutely, yeah.
That would be an ideal thing.
What was this one?
So if you don't have a house to sell, you can still use this product as a renter, but you have the assets to buy a house. And it may be, for many people, the only way they're gonna get a house is using this product. Yeah. I wanna do my drawing. For those of you who've been here before know that I give away 2 $25 gift cards just for showing up. Alright, pick your names.
There's one.
Cynthia. Woo! Yay, you won! Okay, you're welcome. And another?
That's fun.
No peeking.
Got it.
Pam. Oh. Yay! Congratulations, you're welcome. So remember to fill out your surveys. Pass them to me on the way out the door. Whoever, I take all the ones that are filled out completely and I pick from one of them tomorrow, and that person gets a $50 gift certificate that I'll send to you. Any further questions? Thank you to Eric.
Thank you. Sorry about this.
And you're out early. Go have lunch. Or there's more food here. Help yourself to more food.
Thank you for all the questions, that was wonderful.
Okay.